Hello and welcome. Thank you for being part of Equivault Company. Today we are starting our journey together with session number 2. In today's session, we'll cover 4 key topics. 1. The ask and bid price. 2. The types of orders, pending and market. 3. The broker fees you pay to trade. And 4. The leverage, which lets you trade with more capital. In trading, you will always see 2 prices, the bid and the ask. Bid is the price at which the market or the broker is willing to buy a currency from you. In other words, it's the price at which you can sell. Ask is the price at which the market or the broker is willing to sell a currency to you. In other words, it's the price at which you can buy. The ask is always slightly higher than the bid. And remember, these prices come directly from the market and are constantly updating in real time because supply and demand are always changing. And now for types of orders in trading. There are 2 big groups, market orders and pending orders. A market order means you want to buy or sell right now at the current price. Simple. But sometimes you don't want to trade right away. That's when you use a pending order. It's like telling the broker, hey, buy or sell for me later, but only if the price reaches a certain level. There are 4 types of pending orders. Buy limit. You want to buy only if the price goes down first. Sell limit. You want to sell only if the price goes up first. Buy stop. You want to buy only if the price goes up and keeps rising. Sell stop. You want to sell only if the price goes down and keeps falling. When you trade, the broker is like the shop where you buy and sell. Just like some shops charge you a little extra when you buy something, brokers also charge a small cost called fees. These fees are how the broker makes money for helping you trade. Now, let's talk about the common fees in trading. The first one is the spread. This is the small difference between the buy price and the sell price. The second is commission. Some brokers charge an extra small payment every time you open or close a trade. This is separate from the spread. The third is the swap. If you keep your trade open overnight, you may pay or sometimes even receive a small interest called swap. Finally, there is rollover. This usually happens in futures or contracts that have an expiration date. If you want to keep the trade longer, the broker rolls it over to the next contract, and that can cost a fee. To make the idea of spread easier, let me explain it this way. Look at this example with EUR/USD. The bid price is 1.2081, and the ask price is 1.2083. The difference between them is called the spread. So, if we do the math, 1.2083 minus 1.2081 equals 0.0002, which equals 2 pips. A pip is the basic unit or measurement in the Forex market. We will talk more about it later in detail. Think of the spread like a small gap you need to cross every time you trade. It's part of the cost of trading. Now let's see what leverage is. Leverage means using a small deposit, called margin, to control a much bigger amount of money in the market. Look at this example. If you put $1,000 and the leverage is 10 to 1, the broker multiplies your trading power by 10. So, your $1,000 now let you control a position of $10,000 in the market. This doesn't mean the broker gives you free money. It means you are allowed to open bigger trades than the money you actually have in your account. That's why leverage is powerful. It can increase your profit potential, but it also increases risk because losses are multiplied too. Thank you for your attention. Keep learning, keep practicing, and we will meet again in our next session.